Welcome all, and thank you very much for joining us this morning for this global liquidity update. I shall hand over now to Michael.
Good, thank you. Good morning, afternoon, or whatever to everybody who's joined. This is the first of a couple of updates. We're doing another one in a day or so for US and European audiences, but effectively this is the Asian Australia update. And what we're doing is looking at data for May. We finished compiling that yesterday. This is the sort of the first launch of May data, and basically what it's doing, as the title says, is confirming this fact that you've got a very pronounced V going on with liquidity conditions, which is ultimately translating into a V in terms of economies. Now, just to be clear, what we're not saying is we're going to go back to levels of economic activity that we were seeing in January, February of this year, but the speed of rebound is likely to be pretty fast. And at the end of the day, markets are responding to the volume of liquidity. And the point that we've really been making over the last 2 or 3 months is the scale of this liquidity impulse is absolutely huge. And I think that's what's wrong-footed a lot of investors, just misjudging the scale of this. Now, in terms of looking at this next slide, what this is looking at is basically just a bullet point of what the data is saying. And if you take our index, which is scaled between 0 and 100, to show 100 being very, very, very strong liquidity, it never really gets to those kind of extremes. On that scale of 0 to 100, we're up at 85. Last month was 83. We started the year down in the 60s, and that was after a period where the US had actually been increasing liquidity quite aggressively through the second half of last year, really in response to the repo crisis that we were seeing around the middle of 2019. The Federal Reserve has unquestionably been leading this. The Fed liquidity index is up at around 90. That was similar levels to where we were after 2008. So the Federal Reserve is acting in size, but the important thing this time is acting with speed. The speed with which it's got liquidity in is kind of breathtaking. It looks likely to us that the Fed's balance sheet could easily test $10 trillion in 2020. It's already up at 6, so it hasn't really got a lot further to go. But what we're now looking at in the next, well, really from this month onwards, is a very significant increase in Treasury coupon issuance. Most of the issuance we've seen to date has been concentrated in the bill market, but coupon issuance is starting to increase significantly. And there is talk, as everyone's heard, about yield curve control coming through. Our view is kind of good luck with that, because it's not going to be as effective as people are thinking. But ultimately what you've got is a lot of Treasury issuance upcoming. In terms of investors' risk appetite, in other words, where are investors positioning, which is really the key point for equity markets, is that risk appetite is starting to move higher, but latest readings are still showing extreme caution among portfolios. There's a lot of cash still around that has to go back into markets. This whole process, we think, is likely to cause yield curves to steepen. It could easily be the case, if this is a normal response, that the US curve could add up to 150 basis points of steepening. I'll show you the charts a bit later, but that really is what looks to be the measure of what could be going on. So there's a very significant potential sell-off in bonds, which is likely to have ultimately a negative effect on all financial assets in time, but not yet. I think it's much more a 2021 event that you start to see bond markets being much more of a constraint. That may come with higher inflation, as we allude to, but ultimately, for the moment, it's really a shift out of risk-off type assets, safe assets, into risk-on. Finally, capital flows are leaving the dollar. It's a slow drain of money coming out of the dollar, but it looks like it's occurring. And we think that gold and the euro are basically the currencies that will benefit most from this. In terms of the picture of liquidity, this graph is just updating our normal chart. It shows the scale of the liquidity response. It's very clearly a V. you're looking at levels of liquidity that have been touched before, but we very rarely get up to these heights. I suppose you could cynically say that what goes up comes down. So ultimately, one's got to start thinking about when liquidity starts to come out of markets. But for the moment, make hay while the sun shines. There's a lot of cash around. The timeline at the bottom is looking at broadly what happens as how liquidity passes through the system. It begins in the fixed income markets and the Forex markets, and then starts to move out into equity markets and the real economies. So the response that we're looking at, we think is a fairly standard timeline. In terms of a heat map, which is looking here at slide 4, it may be a little bit difficult to discern some of the labels, but the impression is mainly that is what we're trying to get here. What you can see in the heat map is these are at the top of the graph are the major regions. So it says world, developed markets, emerging markets, then US, Eurozone, China, Japan, moving down UK, Switzerland, Australia. What that graph is basically trying to show is that almost everyone, with the exception of China and almost by corollary Japan, are not really easing aggressively. Because China is such a dominant part of the emerging market universe, that's causing a drag on emerging market liquidity overall. Strip out China, though, and other emerging markets are generally loosening policies quite aggressively. The turning point, which you can see pretty much in the US data, occurred around the summer of last year after the problems in the repo market. The US began to ease, but now it's easing clearly in big size. And, we haven't even got probably a bright enough green to actually highlight that. But it shows that there's a very clear move towards more liquidity. And, the other emerging market that we show here, India at the bottom, is clearly moving into that green territory as well. But it's being led by the US and by developed markets, with the exception of Japan. Japan is much more today in the China orbit and seems to be moving policy with more respect for what Chinese monetary policy is doing. What is China doing? The answer is not very much. This is a daily plot of China's liquidity injections into financial markets day by day. This is a rolling 90-day average to show what they're doing. It's measured in billions of yuan or renminbi. And what it basically shows is that this spike here in February was the initial response to the COVID crisis. The Chinese authorities put a lot of liquidity in. However, they've taken it out for the most part over the ensuing weeks. Liquidity conditions are pretty much neutral where we are now. This policy mix, which is here depicting what the People's Bank is doing, is probably a policy, as far as we can see, which is designed to make the yuan or renminbi stable against the US dollar. The policy mix is a little bit skewed in China right now, in the sense that what they're doing is keeping the People's Bank's balance sheet constrained. This is a normal policy when they want to try and contain or limit movements in the yuan and keep the yuan stable. They're tweaking at the margin two other elements which are helping broad credit in China accelerate. One of those is reserve requirements, which they've been dropping, particularly for the regional banks. And secondly, there's seems to be a pickup in directed lending, in other words, through the state-owned banks. So if you look at Chinese credit growth, broader credit growth, the latest 3-month growth has picked up to 18.5% annualized. So there's a big step up going on in terms of the broader aggregates, but it's not really being reflected in the People's Bank balance sheet as yet. As I say, the reason for that is likely to do with currency control. Over time, the People's Bank will start to add more liquidity. But for the moment, China is, if you like, tweaking at the margin to trying to get as much monetary stimulus without weakening the currency. In terms of risk appetite of investors, these charts are very illustrative. This is particularly relevant for equity markets. And what it basically shows is the positioning of investors in terms of the amount of risk assets they have within their portfolios. These charts are drawn as indexes. They typically range between +50, which is showing extreme risk on, to -50, which is showing extreme risk off. Those are normalized data series. What happened in this COVID crisis, as you can probably detect here in terms of these extreme readings, is that around March, April of this year, you got drops in these risk appetite readings of well below normal levels. In fact, if you go right back to when our database started, which is in the early 1970s, these are unprecedentedly low levels. So the scale of risk aversion was just unparalleled. You can see here that it particularly hit developed markets. Emerging markets got clobbered too, but nothing like the same extent. Bearing in mind that China is a large part of the emerging markets and Chinese markets have been more stable. This is largely explained by that. But if you move to the right-hand chart where we show some of the bigger markets, US, Eurozone, UK, and China, what you can see here is that the gray line is looking at US risk appetite or investor positioning. So this is coming directly from data which is showing holdings positions in portfolios. It's not about investor sentiment. In other words, from surveys, it's actually what investors are positioning. And this data we get from national stock exchanges, from administrators and whatever, and compile for many countries worldwide. And what it basically shows in terms of the gray line, at least, is that US risk appetite plunged to these unprecedented. There was a huge move risk off in the US. You can see that in terms of many different dimensions, even investor surveys, but particularly if you look at the inflows that have come into US money market funds, institutional money market funds, which have basically gathered or hoovered up something like $1 trillion through this lockdown period. I mean, just huge amounts of cash, which still seems to be coming in at rates of 150 to 200 billion a month. And as a corollary of that, just to show how much cash is in the US system, if you look at revolving credit data, in other words, credit card data in the US, Federal Reserve numbers that came out 2 days ago show that through March and April, US consumers paid off a whopping $1 trillion out of their credit cards. I mean, there is so much money around, it's almost unbelievable. Anyway, this is basically illustrating that backdrop to show that risk appetite still in the US, and the red line, the UK, is below levels of where you're positioning in Eurozone and China. So it's these markets that still, we think, have good scope. Just to ram home this point about how much liquidity matters to valuation, certainly in the short to medium term, these two charts give testimony to how we see things. The one on the left-hand side is a broad analysis of liquidity growth in orange on that chart. The numbers, or the jump to over 30%, is projected to end of 2020 using the slated increases that we've compiled for what central banks basically say they're going to do, and we've applied that in terms of a multiplier to what it would mean to overall global liquidity. So what that suggests to us is you're easily getting a 30, maybe a 35% jump in global liquidity this year. And if you look at the correlation between that and financial asset prices, which is the black line, financial asset prices are all equities, all bonds, all corporate debt, all liquid assets, precious metal prices, all weighted by market size, put into an index. And you can see that the correlation seems to be pretty tight. Now, in actual fact, if you go to a month-to-month basis, the correlation is not quite as great as it looks at on this chart, but it's still a correlation coefficient of about 0.7. So what one's got to say is that it seems pretty likely that you're going to get a further response in financial asset prices this year. And that black line looks to be trading the amount of liquidity. On the right-hand chart, we look at it another way, just looking at the ratio of all equity assets to this pool of liquidity. That's something we call the PM, or price to money ratio, which is a number that we've been calculating for many years. This series is very clearly mean reverting. If you do statistical tests, it comes out at an underlying level of about 0.55 or 55% around here. The current reading dropped down to low points of below 0.3 about 6 weeks ago. it's now at about 0.37, and this is projected using latest market values and end 2020 projected liquidity, global liquidity. So it still looks on this ratio, which is about 0.37, well below these underlying targets that you get mean reversion back to. So it looks as if there's still a lot of scope for markets to rise. In terms of the economy, are we looking at a V-shaped rebound? Well, I think if you look at the data that's coming out of the US, it seems to be pointing very much in that direction, as we've been saying for a few weeks now. One of the things to look at is what rate expectations are saying. But this is taken directly from the term structure after taking out term premia estimates. And what this is indicating is that it seems as if US fixed income investors, at least, are expecting the path of rates to move up. Now, this is looking at the slope of the yield curve between the front end and about 10 years. So what this is really saying is this is the medium-term expectations of interest rates. So it's very clearly pointing upwards in this V shape, and it's really had this big jump since the COVID crisis. So in other words, what it's saying is that, you know, what goes down must come up ultimately. The blue line is probably of maybe more interest or more immediate interest. And this is coming from a collection of surveys. This is the May data that we put together, which is from Federal Reserve surveys and the Michigan Consumer Survey as well. And basically what it looks at is the differential or gradient between two questions in those surveys. One is, what do you think of the current economic environment? And secondly, what do you think about the environment 6 months out? And what you can see is the turnaround is phenomenal. So that is indicative of how much US consumers and producers expect the economy to turn around. And this is clearly huge gains coming forward. In terms of what that means, this next chart on slide 9 is looking at the yield curve, and it's putting together liquidity in the yield curve. In our view, if you take financial asset prices, equity markets are probably made up of 80% psychological or investor behavior factors and maybe 20% macroeconomics. So although people put a lot of emphasis on trying to understand equity markets through economic analysis, a large part of it is really psychology. If you look at the Forex markets and the fixed income markets, we think that that division is the other way around. Fixed income and Forex are 80% macroeconomics liquidity factors, but only about 20% psychology. If you're looking at a pointer of what could happen, therefore, this is the track between the yield curve in orange and our liquidity series in blue. We've advanced the liquidity data by 6 months to show that it should be a leading indicator. We haven't cheated here by starting in 2001. We draw these charts going right back to the 1970s, as probably many people know. What this is basically trying to foreshadow is that the yield curve is steepening in line with liquidity. That is a term premium effect, as I would explain. But what this could foreshadow looking ahead, at least another 150 basis points of steepening. I know I'll be more than happy with 100, but it looks like it's moving up into this area here. So you could easily be moving towards something like a yield curve, a normal slope of somewhere between 200 and 250 basis points. And this is between 1 and 10-year tenors. If you take a look at what's driving that, what normally occurs is that term premia begin to move up during periods of liquidity expansion. This is the term premia on the 10-year US Treasury in terms of percentage points. The long run average is 0, as you would expect from textbooks. It comes out that way from the data conveniently. What we've got is evidence that during periods of QE, which are shown here in this gray shading, you always get an expansion in term premia. That is 100% contrary to what central banks say. They always say that when they do QE, they push rates down. There is absolutely no evidence of that at all. It's rather the opposite. Every time they inject liquidity, rates go up through term premium movements. when they take liquidity out, what you see is falls in term premia, which is basically what this is evidencing here. And you're beginning to see an uplift in term premia occurring now, which I would fully expect to accelerate through June, which I think we're already seeing in terms of the steepening of the curve that we're spotting right now. The reason this is occurring is simply because in an environment of abundant liquidity, investors can go risk on because systemic risks have fallen because of the amount of liquidity. Defaults will drop, and therefore why own safe assets like treasuries? You want to be holding risk assets. So during periods of abundant liquidity, investors shift out and they go into equities or corporate debt. In terms of putting this together into a framework of what does it mean, we drill down further into the liquidity data and separate out what the policy liquidity is doing from private sector liquidity. Private sector liquidity is basically cash generation of the US, in this case the US, but generally corporate sectors and household sectors, allied with what credit can be raised through banks and shadow banks. So it's that aggregate inflow into the private sector, and policy liquidity is really what it says, what the central banks here, the Federal Reserve, is injecting into the system. Now, the point about the data is something which is, I think, quite interesting. What you've seen in terms of the blue line is very strong accommodation by the Fed, which is clearly accelerated. And this looks pretty similar to what happened in 2008, the response here. Now, unlike 2008, it seems as if there's a lot more impetus in terms of private sector cash generation. And I think that is coming through, first of all, because of the fiscal programs that the US Treasury and others have adopted. So the private sector is getting an increase through normal savings inflows, largely because of these fiscal support measures. So that's looking as if it's sustaining private sector liquidity. On top, and unlike 2008-9, the banks are not the problem this time. So bank lending is going to continue. So basically, it seems as if what you've got is strong impetus in terms of private sector liquidity and in central bank liquidity. And unlike 2008, you don't see this sudden collapse in private sector liquidity. It may come down, but it's not going to collapse in the same way that it did back here. And I think that augurs pretty well for markets and for economies. Now, if you take this split between private sector and central bank liquidity, we use that in our asset allocation framework, which is what we always call the quality as opposed to the quantity theory of money. And one of the things that you can see, I should just go back and explain, this differential between the private sector and the central bank, this gap between private and policy liquidity, is what we use to gauge what the US dollar and what general currency markets are doing. This quality of liquidity means that private sector is good liquidity for the currency, but central bank liquidity is bad liquidity. Now onto this chart, which is looking at the long-term track of that data series. What we've done here is to look at how this so-called Forex risk index, which is private sector less central bank liquidity, moves over time. We've fitted a sine wave to that data, which is basically a 6 to 7 year cycle, and it seems to correspond actually remarkably well. These periods that we've shaded are forthcoming periods or future periods of dollar weakness 12 months ahead. And what it tends to mean is that when you get these downswings, you tend to see generally periods of dollar weakness. Not always the case, but it tends to correspond. And therefore, what we're starting to see, we think, is a rollover of liquidity, which is pointing to some weakness upcoming in the US currency. It may not be dramatic right now, but it's starting to pick up. And I think the other pointer to this is looking at the alacrity with which the US authorities posted swap lines to 14 other central banks in March. The speed of them doing that, unlike 2008, suggests to me that they don't want the dollar to be particularly strong. If you put this framework together, what does it mean? Well, here is a very a simple matrix that says if you take these metrics of central bank liquidity and private sector liquidity, It tells you what's going to happen in markets. And generally, high private sector liquidity and high central bank liquidity, which is what we've got now, is an environment where bond yields rise, largely because term premia are themselves beginning to pick up. If you've got a combination of high private sector liquidity and low central bank liquidity, currencies are strong. That's what we've been coming through over much of the last 3 to 4 years with the US dollar. That is now changing. We've shifted from here, top left, into top right. We're not anywhere near this period here, which is exchange rate weakness, but we may be inching towards that box. So you've got to see a big drop in private sector liquidity before we get there. But effectively, what you've got to start thinking about is a rotation around this diagram. Now, that is basically what we see historically. This sort of snail diagram that we've put on top is looking at the combinations of private sector and central bank liquidity for the US, and you can see how that migrates through time. Generally, we've been up in these areas for much of the last few years, and we're now shifting out towards this 2020 point in the top right. And that would suggest to us that it's an environment where bond yields are the thing that's under pressure. We've moved from a strongish exchange rate regime through here into a period where, and by the way, falling bond yields, into this period where bond yields are now starting to rise. What does it mean for equity markets? Well, this is just very crudely saying, look, if you want to look at sector performance, what you would normally find is that in an environment where you've got very high central bank liquidity, where you typically find bond yields rising and maybe exchange rates weak, that's an environment where value stocks outperform. If you're on this left-hand area where you've got low central bank liquidity and potentially either high private sector liquidity with a strong exchange rate or low private sector liquidity with falling bond yields, that's typically when growth stocks outperform. They like falling bonds, they quite like strong exchange rates. On the other hand, value stocks tend to like exchange rate weakness and rising bond yields and steepening yield curves. In fact, if we go back, you can see this period here, which is really when value stocks outperformed. You've got to go really right back here to the early part of the 2000s to start to see value stocks outperforming. Much of the last few years has been invested on this this left-hand slide, where you've got growth as the main driver of equity performance. In terms of the final couple of charts of what we're seeing, this is probably something to bear in mind, and it's something which is more of a bogey for 2021, but I think one's got to start to look at what some of these implications really are. The backdrop is one, as we've said, where liquidity conditions are rising at unprecedented rates. Global liquidity could easily be up 30–40% this year, which would be record levels. Already, if you're looking at broad money growth in the US, latest monthly data still shows data even through May rising at an annualized 40%. So there's a lot of liquidity growth out there, which we think people have underestimated. Will that be inflationary? History tells you it will be. I'm not going to detract from that because I think there are inflation risks. And if you start to look at data, this data here is looking at supplier delivery times. And the question to ask is, how does inflation start? And how did it start in the 1970s? Now, this question, supplier delivery times, is a question from the US ISM monthly index, the Purchasing Managers Index publication, which has supplier delivery times as one of the key questions. It kind of moved into vogue probably, well, I'm going to say maybe 20 years ago now, when Greenspan, remember him, used to look very closely at that as an indicator of future US inflation. He said on all his research that this was by far the best indicator, future-looking indicator of US inflation pressure. Here it is shown as the orange line, but advanced by 12 months. alongside US CPI inflation through basically the 70s and early 80s. And it seems to be quite a good predictor of the turning points in the cycle then. Now, clearly it may be different this time, but what you've seen in the US is this pattern recently. Here is US CPI inflation, and here is supplier delivery times advanced by 12 months. Now, we've seen a big pickup in delivery times, a lengthening. That's effectively because the COVID crisis interrupted supply, not surprisingly. What we've seen so far is central banks and policymakers restoring demand and restoring incomes to the bulk of the population, but there's not much they can do about disruptive supply lines. And that may be a question that's coming up. And what I would say is this anecdotally, looking at where people are consuming and buying, when they're trying to get goods, they're clearly not looking at discounts. They just want to buy. And that would suggest that there may be a build-up in this inflation pressure. And I'd be looking very closely at these supply and delivery times over coming months. Is that going to be a major issue? Well, it could be. But let's just look at the inflation risks for financial assets as a final slide. What this chart here, or these two charts, are showing is one of the valuation indicators we look at for financial assets. It's theoretical on the left, and it's practical on the right. Let me start with the right-hand chart. This is the CAPE index of Robert Shiller, the data from his website, purely plotted against inflation on this bottom axis. So here is the CAPE on the north-south axis, and here is the inflation rate. And this data goes back to 1880 monthly. So what you see is this scatter plot. What we've done is we've fitted a polynomial regression line, which is basically a cubic function through here, to show that what you get is this very neat trade-off. What it's saying is that equity valuation is not is basically curved in this shape, where what you see is a peak equity valuation of low inflation rates of about 1 or 2%. Either side of that, equity valuations fall. If you move to deflation, equity valuations drop, and if you move into inflation, equity valuations drop. So if you put this together in a valuation framework, the yellow line is that same curve here, which peaks at around, I mean, this is a long run average, but it's fitted here at about 20. And what it shows is you get this peak valuation at around 1-2% inflation. The red line is fixed income valuations on a similar inverted yield basis, and the dotted line is real assets. Now, the key point about this chart is that equities see their peak valuations at low inflation. Bond markets do well as inflation drops. There's a sort of monotonic relationship going on here. But basically what it's saying is that the valuations of bonds, the inverted yield here, is going up as we move towards deflation. And the opposite occurs for real assets like commodities or real estate. Now, what's really important in this graph is that in periods of low inflation, equity markets and fixed income markets are negatively correlated up to here. Anything to the left of this point, you've got negative correlation. As you start to see higher inflation, equities and fixed income markets start to correlate more positively. And around this point, there's a very important crossover. Now, the point about this diagram is really to say, is if you're in very low inflation or deflationary environments, bonds look better. As you start to move towards low inflation, we'd start moving towards more equity exposure. And if you start to move towards a moderate inflation backdrop, then you've got to start thinking about more equities, less fixed income, more real assets. And if you go to a high inflation environment, then real assets come through to the fore. This was the period of the 1970s, and all financial assets, equities and bonds, look bad. So we think we're moving into this kind of area probably, which means you want less bonds, a bit more equities, and start thinking about more real assets like gold or whatever. And you can't get away from the fact But what we've got here is a huge monetary surge that is still dissipating through the system, and that is going to be asset price inflationary, but in the medium term, high street inflationary. Let me stop at this point and see if there are questions, and I'm happy to answer any points people have, if there are questions. Maybe can we see if there are questions, or maybe Tom, you can unmute people.
Yeah, so if anyone has a question, then feel free to put it in the chat, and then Michael can patch you through. So if you do have any questions, then feel free to put them in the chat.
A question coming up.
There we go there.
Let me unmute Stephen. Unmute. I can't see unmute. Right. Can you unmute, Tom? Or?
I think that's you're the host, so.
I can't seem to. I did it then. It's Stephen, you're on. Sorry.
Michael, what's the prospect of a big drawdown in markets later this year, or potentially early next year, following perhaps the patterns of earlier big market corrections?
Okay, well, I think this is the question that is clearly the prime question. Should we be piling into markets now, or will there be some sort of adjustment? I think there are two things to say. I mean, one is that you've got what generally causes market corrections, the scale you're talking about, would be central banks tightening again. If there is a move towards some sort of tightening, and I think that could easily occur if you get an inflation problem. Now, the issue is that when the central banks press the panic button, and I think it's going to be later rather than sooner. So everything they've said would suggest that they're going to keep rates at low or zero levels for the indefinite future, maybe 2 to 3 years out. I think that's a commitment that they're going to find hard to keep if inflation picks up. And I think that notwithstanding all these points about deflation, capacity gaps and whatever else, I still think you can still see some inflation beginning to come through. And that would be my concern. In the near term, I'm sure I'm in the camp that says deflationary pressures are around, but I think that's going to turn around given the huge amount of spending that's if you like, being stored up. And if you come back to that observation that I made, look at the alacrity and the size with which consumers around the world are paying off their credit card bills. And this is unprecedented. And it shows there's so much cash around. Now, I think that there's going to be mean reversion. So what I would say is, in terms of asset allocation, you're going to move back to a more normal equity allocation, which still means people have got to buy. I think if you get a situation where bond markets start to see yields rising, which is what we're starting to see now, and the question is how far can that go? I think it goes from a lot further. Then you're going to see asset allocation shifts out of bonds. Where is that money going to go? There's not many places it can go apart from equity markets. So I think what you'll get is a further run in equities over the rest of this year. Then I think, as you rightly say, there is a question to ponder in 2021, and that's much more about, do we get a correction caused by, I think, central banks tightening? And I think that's the time to start worrying. I don't know whether that will happen. I think there are risks, but I think those risks really do lean on the inflation outlook. But I think for the next 6 months, we're not going to see the sort of gains that we've seen in the last 2, but I still think there is room for markets to move up. And if you come back to that valuation indicator, which is saying in the long run, total value of equity holdings to liquidity is 0.55. We're currently at 0.37. There's still, quite a lot of scope to come for markets to move up.
Michael, just a supplementary, and thanks for the excellent presentation. It's just fantastic. Is central bank not expanding at astronomical levels equivalent to a tightening? So for example, later in the year. Yep.
Yeah, okay. I mean, that's a fair point. And I think that, you know, if you get central banks which are beginning to slow up, you know, is that equivalent to a tightening? I think it comes back to, I think that is a very good point to bear in mind, because markets get used to a certain pace of liquidity, and if you see falterings in that rate of expansion, then there's a question. So you've got to start looking at the if you like the second derivative of what's going on here. So I think that's quite valid. If you start to see a significant slowdown in the pace of gains, which likely will come, you know, I think sometime towards the end of the year, then there could easily be, you know, some nervousness. But I still think we've got to, in the nearer term, my view is still that there's a lot of liquidity out there, which is going to start moving into markets. But clearly, we've got to be sensitive to these inflections. Markets don't go in straight lines, and they don't rise to the sky. We know that. They humble us.
Thanks, Michael. Appreciate it.
I think there was a question from Mark. If I got
Yes, can you hear me?
yeah, can yeah.
So thank you again for an excellent presentation. I just want to return to the subject of Japan. Now, I recognize you've made the point that they seem to be managing their currency against some kind of informal basket, which is half USD, half yuan. So it's been relatively stable. But apart from that, because they were the first to engineer low rates in the early 90s, is there anything else you see in the monetary aggregates that perhaps would suggest that the incidence of inflation will be felt first in Japan? So this is a question.
Yeah, look, I mean, Japan's a very interesting sort of laboratory, I suppose, of these kind of effects. And you know, Japan is a very key leading indicator. And I think there are two takeaways that we ought to bear in mind up front about Japan. One is that if you come to this question of bond markets, look at the yield on the JGB. It saw its low last year, not this year. The yield on the JGB is beginning to move upwards, and I think that's a significant pointer for maybe building inflation pressures. I don't want to get carried away by that, but that's a reality. The second thing is that if you look at yield curve control in Japan, and the Japanese, as you know, have been basically targeting a point on the term structure at about 10 years, and they've basically taken, tried to keep that yield down at 0%. Now, there are 2 pointers here which are very important for looking at what the US is doing and maybe the implications for the fixed income markets. One is that although the Japanese have tried to push yields down, they have not killed volatility in the JGB market. Volatility in the JGB market currently is higher than it was before they started yield curve control. So that's point number one to think about in terms of where we are now in bond markets, because the MOVE index in America is virtually at all-time lows again. Second point is look at the pattern of the term structure in Japan. And basically what you've got going on is a situation whereby beyond 10 years, in other words, looking at 20, 30, 40-year JGBs, the yield curve is very steep. So they've been squeezing the balloon in one spot, but they've basically shifted the air further up the curve. And I think that's a real risk if you start to look at what's happening in the US. There's a lot of talk about yield curve control going on. Some FOMC members favor it. The problem is, where do they actually choose to pin the curve? They can't really do it at the longer maturities because they've only just started issuing 20-year debt again. The 30-year is too illiquid. There's too much of a gap really between the 10 and the 30 for them to really be effective in a sort of illiquid part of the market. So they're going to be forced into the front end of the curve, maybe, as people are talking about now, 2 to 3 years out. So that will basically mean that you could get quite a steep curve. Now, what are the inflation implications coming through from all that as well? What's the background from Japan? Well, I think we've got to remember that in Japan's case, you haven't really seen a huge amount of monetary growth. The monetary growth is spilling over from the US and potentially from the Eurozone markets. I think what you are seeing, though, is that Japan is a sinkhole for cost deflation coming out of China. And it's that which I think is much more of a sort of bellwether of what's going on. And I would suspect that what you're likely to see, particularly with this supply chain disruption, is that cost pressures in China are beginning to pick up. Chinese inflation is itself starting to lift off. I forget the exact numbers now, but I think it's about 2 or 3%. And that is maybe having an effect. So I wouldn't rule out inflation picking up in Japan, but you've clearly got these drags from technology, from demographics, and from China, and a lack of extreme monetary growth, which is saying that maybe Japan is not necessarily going to be the first to show it. But I think in terms of bond market characteristics, if there is some sort of general global benchmark, the JGB is behaving or is not behaving as if we're seeing renewed deflation. And that answers your question. And I think I didn't maybe mention the point about the currency, is that if you look at the yen, and you look at the yen against a basket of dollars and Asian peer currencies, the yen is just going sideways. It basically is not hardly moving. It's within about a 5% band. I've never seen that in 30 years of looking at the yen. They're almost deliberately targeting it, and they've been doing that since 2017. And I think they're paying a lot of attention to Chinese monetary policy in doing that.
Thank you.